Good morning, ladies and gentlemen. Welcome. On behalf of Czech National Bank, let me welcome you in this meeting with analysts. This session is focused on the new macroeconomic forecast, which was the basis for the yesterday's monetary policy decision to rise key interest rates by another 75 basis points. Let me introduce the speakers of today. The bank board is represented by Mr. Tomáš Nědecký, Deputy Governor. The other speakers of today ready for the presentation and for the discussion are Petr Král, Executive Director of Monetary Department, and Karel Musil, Director of Macroeconomic Forecasting Division. As traditionally, we will start with the presentation of the new macroeconomic forecast. The speaker of today is Petr Král. Mr. Král, the floor is yours.
Thank you for the floor. Good morning, ladies and gentlemen. Also from my side, it is really my great pleasure to be here after 3 months to deliver the new CNB's quarterly macroeconomic forecast. My presentation will have the structure such as follows. First, I would like to stress the assumptions based on which the new forecast was prepared. After that, I will go into the in-depth insight into the plot of the new forecast, touching upon its qualitative story and its quantitative dimension. And final part of my presentation will be dedicated to a brief comparison of the new forecast with the previous one. The countries of our major trading partners, which is the euro area in the effective terms, are currently continuing to recover from the pandemic, but the recovery of the economic activity is somewhat curbed by the Omicron COVID wave and by continuous problems in global value chains, which are especially relevant for industrial countries such as Germany and Slovakia. Despite this, we can expect that COVID will be shortly over and economic activity will be growing quite significantly, and also the problems in supply and producer chains will also gradually fade away. This will lead to the quite strong GDP increase this year at approximately 4%, and this growth should accelerate a little bit further next year. The problems on in the global value chains, combined with the restructuring of the global demand from services to industrial consumer goods, and recently very steep increase in energy prices, has led to a sharp acceleration in the inflation in the producer sector. The PPI growth in the effective euro area has reached approximately 20% in recent years, and this has been driven primarily by the contribution of the energy sector. But the worldwide strong demand for industrial consumer goods has also driven up the contribution of core inflation segment within this PPI growth. The crude oil price has gone up in recent months, being currently close to $90 per barrel, and we can expect only gradual decline of crude oil price over the forecast horizon. The relatively very strong inflation pressures are reflected in the market outlook of future easing of the current very accommodative monetary policy stance of the ECB. And the ECB, on its December meeting, outlined its plan to cancel its pandemic emergency purchasing program and to gradually decrease the other purchases over the next couple of quarters, which is reflected by the market outlook of increasing Euribor 3-month rate above zero, slightly above zero at the end of our forecasting horizon, and the shadow rate will gradually converge to that level over the forecast horizon. The Fed is also expected by the markets to start tighten its monetary policy relatively very soon and relatively quickly. As for the observed PPI growth in the euro area, we have now at our disposal quite thorough analysis of the underlying processes. Besides standard crude oil price and its derivatives being the part of energy component within this breakdown, we have enlarged this component by including into it also natural gas and electricity prices to be able to fully track what is going on in the producer price costs in recent months in the world. That's why the energy component, being newly more widely defined, is taking very strong contributions in recent quarters, leading to that very strong acceleration of quarter-on-quarter PPI inflation. But besides this, there is also a gradually increasing contribution of core inflation segment. We can expect that after these spikes in electricity and natural gas on commodity exchanges, there will be a period of time with flat prices, and only from the beginning of next year there is some chance that those prices will slightly decline. Following that, the domestic the domestic prices of energies are also under quite significant pressure. But until the end of last year, the regulated prices or prices of energies related to housing were quite subdued, or their growth was even slightly negative due to the waiver on the VAT, which was imposed by the previous government to be in place for November and December last year. That's why until December we saw a slight year-on-year decrease in regulated price segment. But following the fading away of this one-off waiver on the VAT, we can expect very sharp acceleration of regulated price growth with electricity, natural gas, and heating prices being drivers of that very strong acceleration. So we can expect that over the next couple of quarters, regulated price growth will fluctuate somewhere around 13%, and only at the beginning of next year we can expect deceleration of that growth to more than 4%, which is still somewhat higher compared to what we have seen in previous periods. As for the final economic policy assumption regarding the Czech Republic, we can expect that fiscal policy will turn to a slightly contractionary or a restrictive stance, following primarily the things that many of the last year's supportive measures were approved to be only temporary, and they will expire this year. Simultaneously, the very strong nominal government consumption growth in 2020 and 2021, which was very closely related to the spending in healthcare system, will decelerate, or already has been decelerating, and this deceleration is expected to continue also for this year. That's why overall we can expect minus 0.6 percentage point contribution of fiscal policy to GDP growth this year. The fading away supportive measures will be to some extent offset or slightly compensated by accelerated public investment benefiting from the accelerated drawdown of EU funds, together with some extra increases in pensions going beyond the standard indexation schemes. For the 2023 year, we expect, or we assume, neutral fiscal stimulus as our forecast for that year, as technically based on no policy change scenario. The domestic economy and the Czech Republic as such is also going through the Omicron pandemic wave. The numbers of daily confirmed cases have gone up very sharply in recent weeks, but the ability of the society to withstand such another wave of pandemic is quite strong. We haven't seen much severe cases being taken to hospitals, and that's why we expect that there will be no additional pandemic measures taken by the government that would negatively influence the economic activity. That's why our forecast is based on such an assumption that there will be no significant impact of the pandemic, of the anti-pandemic measures on the economic recovery. When looking at the recent available data from the household consumption side, we have seen that the consumption of households as such has got even above the pre-pandemic level. The same is true for retail sales, and the mobility in the most important sectors such as retail and recreation has been significantly above level we saw last year. That's why we can say that there is quite negligible effect of the current pandemic wave on the economic and social lives in our country. Let me now turn our attention to the macroeconomic forecast as such. The currently strong increasing prices are expected to accelerate their growth further, and inflation will be above 9% as from the beginning of this year. This acceleration of inflation will be driven by further pickup in core inflation segment, and the already mentioned regulated price growth will also accelerate very strongly, leading to that peak of inflation, which will be distributed over time during the first half of this year. Domestic demand pressures that are in our core model identified by the margin positive gap in markups are also contributing to the accelerated price growth, and we can expect that this demand side factor will fade away relatively gradually. But following that gradual decline in demand pressure and following the gradual decrease in cost push factors from both domestic and foreign economy, we can expect that after that peak in the first half of this year, inflation will gradually move down, will revert down, and will go first to the upper boundary of our tolerance band at the turn of this and next year, and gradually and further decline to the vicinity of our 2% inflation target during the first half of next year. Monetary policy relevant inflation, which is headline inflation excluding primary effects of indirect exchanges, will be slightly below the headline inflation over the whole forecast horizon due to the further increases in excise duties on tobacco products and following the base effects of the last year's waiver on VAT concerning electricity and natural gas for households. As for the structure or breakdown of the expected acceleration of inflation, as I was already mentioning, the core inflation segment will play the major role, but the administered price contribution will also go very fast up. This together with still very significant year-on-year growth in fuel prices and relatively heightened inflation in food price segment will mean that inflation will be somewhere between 9 to 10% starting from January until at least May or June this year. Core inflation will be driven by the still very strong contribution of imputed rents, which weight in the Czech consumer basket is relatively important or significant, and this high growth in unoccupied housing prices are driven by the rapidly growing residential property prices in our country, together with increasing prices in construction sector, in construction works, and prices of materials consumed when constructing. Food price inflation will be also quite heightened for a certain period of time, being driven by domestic demand pressures and following the outlook of agriculture producer prices in the world. Fuel prices, which has been until now the most rapidly growing part within the consumer basket, is going to gradually slow down, reflecting the expected stabilization of crude oil price and the expected appreciation of the currency against the euro and against the dollar, which is particularly important in this segment. From time to time, we discuss with inside in the bank and with our audience to what extent the domestic inflation pressures are driven by domestic factors or by the import factors, and to what extent the overall price growth is driven by individual relatively limited segments within the consumer basket, and whether this is a more broad-based phenomena. This analysis is showing that the currently very rapidly growing prices are a consequence of the not only of the intensity of price growth in individual segments, on individual categories within the consumer basket, but also the broad nature of the rise in prices is currently present, as is nicely illustrated by the upper chart, where you can see that currently, compared to the situation 2 years ago, the whole distribution of the price increases has been shifted to the right, and there are some categories exhibiting much faster year-on-year price growth than 2 years ago. The across-the-board character of the current inflation is also nicely illustrated by the heat map below in this chart, where you can see that the orange and red colors are currently spreading out almost all over the whole consumer basket segments. This is I would say, very nicely illustrating the fact that the Czech National Bank has been repeatedly saying that domestic and fundamental part of inflation the domestic part of inflation has been playing a very important role in the overall price developments, and this domestic part of inflation is persistent, is robust, and is needed to be addressed by the monetary policy actions. Let me now offer you another insight into the structure of inflation factors in our economy. In the upper chart, you can see that the currently peaking growth in Q-on-Q dynamics of the nominal costs in consumer sector is a reflection of the accelerating of import price component within these costs. This import price component has two parts. The first one and the bigger one is the energy component from imports, which is, as I was already mentioning, more widely defined, including, besides oil prices, also electricity and natural gas prices. But we can also see the core import price segment contributing non-negligibly to the overall import price pressures. Besides that, there is a culminating contribution of domestic economy or intermediate goods costs reflecting the situation in the domestic economy and labor market. This is in more detail broken down in the lower chart. Here you can see that wages in market sectors have been steadily contributing to the domestic inflation pressures, and we can expect that those pressures will subside only gradually as the persistence of the overburdened labor market, the persistence of the nominal wage growth in market sectors is relatively very high. The recovery of the economy from the pandemic and the overall optimism among firms and expected future growth in domestic demand is manifesting itself in this graph by increasing contributions of price of capital, and the counter-inflationary factor is traditionally in the growing labor efficiency, as the productivity gains typically somewhat compensate for wage increases and curb the resulting overall inflation, domestic inflation pressures. The Czech labor market has been cooled down during the pandemic only relatively mildly and for a relatively short period of time, and following the recovery of the economic activity which started in the summer last year, the tightness on this labor market has started to increase again. This has been seen by the increase in total employment and the gradual decrease in the rate of unemployment. There is not much room for further decrease in the unemployment rate, as the labor market is very exhausted, and the continuous growth in the employment will be to a certain extent covered by gradually increasing labor force. Fundamental wage growth in the business sector has been accelerating throughout the second half of last year, and this acceleration will continue at the beginning of this year. This will reflect the tightness of the labor market and the fact that workers will try to be compensated by the inflation and by the loss of purchasing power of their wages by additional nominal wage increases. This effort will be promoted by another increase in statutory minimum wage and by the increase of the guaranteed wages in the cascade above the minimum wage. That's why the nominal wage growth will be accelerating somewhat from the current levels in the next couple of quarters, and only after that there is some tendency in it to decelerate. This is when looking at the fundamental wage growth, which is our analytical estimate of the underlying wage pressures. The official time series of observed market wages will be still very volatile due to the previous statistical effects that led to that heightened volatility of year-on-year changes in the officially published market sector's wage. The volatility will be present also in non-market sector wages, but those as a whole will decelerate when compared to the previous years, as the new government has taken some steps in this field. As for the domestic economic activity, we can expect that after last year's approximately 3% growth, the same pace, roughly the same pace will be present also this year. GDP growth will be driven primarily by household consumption and by private fixed investment. The currently subdued export performance of the Czech economy, closely connected to the problems or disruptions in the functioning of global value chains, will be in place throughout almost the whole 2022 year, and only after that we can expect some easing of these problems with export performance going up, and the net export contribution will turn from negative to significantly positive for the next year. So we can expect that GDP will grow at approximately 3% this year, and we foresee some acceleration of GDP growth for the next year. The flash estimate of the Czech Statistical Office for the fourth quarter of last year, which was published 2 days ago, is pretty nicely in line with our backcast of that period of time. That's why we are not we were pretty close to the observed economic activity in the very end of last year. As for the household consumption, its year-on-year growth will be at the beginning of this year very strong, but this will be a consequence of low base of the respective periods of last year, where the economy and the whole country was under very strong lockdown. That's why these very strong year-on-year figures must be seen in that perspective. In Q-on-Q dynamics, we expect that there will be some deceleration on Q-on-Q growth from the very beginning of this year, as households will face dramatic increase in price level, being driven by both core inflation and regulated price segment, as I was describing a little while ago. So despite the nominal wage growth and nominal disposable income growth, the real purchasing power of households will be under pressure. The real wages will decline somewhat this year, and the overall real consumption growth in Q-on-Q terms will be driven especially by spending for savings that were created during the previous pandemic waves when the economy was under lockdown, and also the pent-up demand will be somewhat spent, especially when the households will have some tendency to speed up their spending to let's say protect the purchasing power of their incomes and of their savings. But all in all, the Q-on-Q dynamics will be relatively subdued during this year, and only gradual acceleration could be expected for the second part of the forecast horizon. The gross fixed capital formation of corporate sector will be the fundamental primary driver of the quite heightened investment growth this year. The private investment will be motivated by the fact that the labor market is exhausted, the labor force is scarce and expensive, and firms will invest into automation to be able to cope with the increasing demand under such situation on the labor market. Government investment growth will be also continuing as the Czech authorities will try to spend the available money from EU funds, including NGEU. The whole dynamics of gross capital formation will be influenced by very strong and very volatile contributions of changes in inventories, which reflect the fact that Czech firms were not able to produce smoothly during last year and during this year because of the problems in disruptions in global value chains. Those problems will continue for some time, being despite somewhat less acute and less severe compared to what we had anticipated in our previous forecast, but they will still be here. That's why the export dynamics will be relatively very subdued this year, and only starting the end of this year, there will be some significant recovery of the export performance, which will be generating positive net export contributions to the GDP growth. As for the monetary variables, I'll start by describing the forecast or the outlook for nominal exchange rate. We expect that in the first quarter of this year, the nominal exchange rate of the koruna towards the euro will be on average at 24.5. The koruna will strengthen further to approximately 24 crowns per euro in the next couple of months, following the very widened interest rate differential vis-à-vis the euro. After that, there will be a tendency of the nominal exchange rate to stabilize slightly below 24 crowns per euro. This will be a result of two mutually opposite tendencies. The first one will be the still very strong interest rate differential, but this differential will be somewhat declining as from the second half of the forecast horizon, as the ECB and the Fed are expected to tighten its monetary policy. So there will be some latent pressure on the exchange rate to somewhat depreciate, but in the opposite direction, there will be a still significant contribution of the real equilibrium appreciation of the domestic currency, which is connected to the real convergence process. And in the same vein, there will be some positive influence of the recovery on the export performance and the positive net export contributions to GDP growth, which I was just describing. So the outcome will be that the koruna against the euro will be stable, slightly below 24 crowns per euro, as from the mid of this year onwards. Consistent with the new macroeconomic forecast is a substantial rise in domestic market interest rates, followed by their gradual decline from the second half of this year onwards. The initial increase in rates reflects a need to react on the combination of strong inflation pressures from both domestic and foreign economy. The tighter monetary policy will dampen those pressures, will prevent inflation going upwards or going above the inflation target on the monetary policy horizon, and will also help to anchor inflation expectations of domestic firms and households. In the middle of this year, the monetary policy, which is reacting in a forward-looking manner and is looking at the monetary policy horizon, which at that time will be at the second half of next year, the monetary policy will see that inflation has been taking down to the vicinity of 2% inflation target, and that will enable to start gradual decline in nominal interest rates to gradually decrease towards the policy neutral rate of 3%. Let me conclude my presentation by a short comparison of the new forecast with the forecast which was prepared during autumn last year. As for the foreign economy variables, there is no much change in the outlook for GDP growth in the effective euro area. The assumption of the gradual fade away of the problems in supply and producer change is still very significant and very significant assumption underlying our current forecast. The outlook for PPI growth has been shifted very strongly upwards following the observed data for the last months of previous year, and the story is what I explained during the first part of my presentation. The crude oil price is an important part in this story, and its outlook has been shifted also somewhat upwards compared to the previous forecast. And the same is true for the assumption of foreign monetary policy, where the market is now expecting somewhat sooner and maybe somewhat steeper increase of monetary policy interest rates of the ECB, which will lead simultaneously to the increase of the shadow rate, as we expect roughly the same pace of tapering of the programs of the ECB. As for the comparison of the variables from the domestic economy, we have shifted up the outlook of CPI growth very substantially. The previous forecast foresaw that average inflation in 2022 will be 5.6%. The current forecast, the new forecast, is shifting this figure up to more than 8%. And here you can see the profile, and you can see that the upward revision is primarily related to the 2022 year. Except food price growth, all components within this CPI price growth are responsible for that shift in the inflation outlook. As for the GDP growth, we expect somewhat stronger figures at the short end of the forecast horizon compared to the previous outlook, but there will be somewhat milder economic growth in the longer end of the horizon. The downward revision of the GDP outlook in a more distant future is primarily related to more subdued outlook for private consumption growth. Higher forecasted inflation and more tightened labor market has led us to increase the outlook for nominal wage growth in private sector, as is illustrated in the lower left chart. The outlook for the exchange rate of the koruna against the euro is relatively the same. We've started with somewhat weaker levels at the end of last year and at the beginning of this year compared to the previous forecast, but the appreciating tendency of the currency is now somewhat steeper compared to the previous outlook as the interest rate differential is being widening somewhat more rapidly. At the end of the forecast horizon, the exchange rate level is roughly the same as it was in the previous forecast. And the final graph is dedicated to the comparison of the interest rate outlook with the previous one. We have shifted our interest rate forecast upwards quite significantly on the whole forecast horizon. The primary contributions to that shift were the initial conditions, reflecting higher wage growth observed in the previous year, together with more pronounced increases in prices in abroad. The outlook for interest rates is also affected by the heightened forecast of regulated price growth and overall the near-term outlook for CPI growth for the first quarter of this year. Foreign outlook has been also pushing somewhat upwards, especially on the longer term of the horizon, as the monetary policy of the ECB is now expected to be somewhat less accommodative compared to the previous assumptions, and the same is true, and the same pressure can be expected from the weaker euro-dollar exchange rate. Expert adjustments also contributed to the upward revision of the interest rate outlook as they reflect somewhat longer-lasting supply chain problems, which are basically somewhat less severe compared to the previous assumptions, but will be with us for some longer period of time, curbing the productivity gains compared to the previous assumptions, which has this pro-inflationary and effect, which is also reflected in this upward revision of the interest rate outlook, especially in the longer term, longer term. I would like, ladies and gentlemen, thank you for your attention by now, and I am passing the floor back to our spokesperson, Petra Odstrčilová.
Thank you, Mr. Král, and now we can turn into the discussion. The first question will be from Mrs. Tenconi from Wood & Company.
Good morning, and thank you very much for the presentation. I would like to ask, how confident are you that wage growth is going to eventually slow down, given that you see the unemployment rate rising, dropping further? What prevents wage growth in the Czech Republic to go into 10, 12%? And as a corollary to that, you have a really nice chart looking at the breakdown of contributions to consumption. Do you think that the rise in energy prices will really have a temporary effect on consumption, or could it be a longer-lasting drag? Thank you.
I will start, and I will ask my colleague Karel Musil to contribute also to the discussion by adding some details. The wage growth in the forecast is basically based on the fact that inflation expectations of Czech economic subjects will stay anchored to the 2% inflation target, and that everyone knows that the Czech National Bank as a monetary authority is combating inflation by increasing nominal interest rates and by letting the exchange rate to appreciate, which both will stabilize the economy, the overheating economy, and will help bring inflation back to the target on the monetary policy horizon. that's why the model and the forecast ends up the story with gradual convergence of nominal wage growth back to its steady state levels, which are at 5% for nominal market sector wage growth, which is a sum of 2% inflation target and 3% steady state productivity growth. We expect that the stabilizing effects of monetary policy will lead to the gradual convergence of the currently positive output gap to zero. So the currently overheating Czech economy will not escalate. The problem will not escalate. It will gradually diminish over time. The tightness of the labor market will continue for some time, but it will not escalate further. And the whole macroeconomic situation will be then consistent with the decrease of the nominal wage growth back to the steady state levels. Would you like to add something? And as for the breakdown of the household consumption growth and the effects of possibly longer-lasting dampening effects of energy price growth, this is something which was quite thoroughly discussed during the preparatory phase of the new forecast, and we discussed it also with the bank board. Possibly Tomáš Nidecký could add something from the monetary policy perspectives or policy perspectives. In our case, we've taken into account that the forced savings that have been created in previous quarters have been gradually spent, but these are still not fully exhausted. So we are approximately halfway through with those savings, and there is some potential, especially for low-income brackets, to use these savings to, let's say, compensate or to smooth the consumption behavior over time, especially in the times where when the price growth will be very strong and very significantly driven by necessities like energy prices. That's why in that graph you could have seen that the forced savings have the bigger impact at the very beginning of this year, where the shock will be very severe, and they will turn into the opposite direction after this initial shock somewhat eases during the next couple of quarters. Karel will add.
Yeah, I will just add that really, as that was one of the issue that we discussed during the preparing of the forecasting round. We prepared also a box that is quantifying this impact, and indeed using the individual data that we have available for this analysis. In case that there is an increase in energy prices, let's say about 20%, which is roughly the increase that we are observing and expecting that will finally materialize, then the impact on the real consumption of households will be something like a decline by 2.5 percentage points. But what is necessary to highlight is also the fact that it won't be evenly distributed among the households. For sure, there will be a bigger impact on the low-income households, and then not really severely hitting the remaining households. And that's something that we expect that it will last throughout this year, and the households will be somehow able to at least partially compensate this impact by the forced savings that are generated or that were generating during the COVID period.
And if I can add to labor market, definitely we all know that labor market residential real estate prices and core inflations are the main drivers behind our monetary reactions. This is what we have done yesterday and a couple of meetings ago. And really we are aware of the situation on the labor market, and that's the reason why we in the past or recently increase our rates, just to avoid that the negotiations on wages between employers and employees will be, or the topic of inflation will be part of these negotiations, not only for this year, but also for the next years. Yeah. So we want to prevent these situations in the next year.
Thank you very much. If I can ask a follow-up on the energy part. Have you looked at the impact on profitability of small enterprises in particular, and what is the risk that you have a cascading effect on their employment decision and then a further impact on compensation of the lower income workers? Thank you.
There was indeed another box that we have prepared, so we didn't check only the impact of the jump in energy prices on households, but at the same time also on the companies here in the Czech Republic. And indeed, the situation is, I would say, slightly favorable, more favorable for the companies, as the share of the costs that are spent on the energies is not really high in case of the Czech companies. Indeed, there is clear tendency of reducing the costs for electricity and gas during or when they produce. And indeed, the overall picture is that really what is clear right now for the Czech companies is that not only the costs for energies are somehow influencing them, but also the problems with the supply of the materials and other components are somehow highlighting as a problem. And at the same time also the costs for wages and payments related to people or hiring people are not really small. So indeed, there is a combination of the factors that are somehow complicating the situation for the Czech companies. But at the same time, what is true, at least right now, is the fact that still a strong demand that is present here somehow allows to increase the prices of the companies and partially reduce the impact of the higher costs on their business and spread it also to the consumers.
Thank you. Next question is from Mr. Minčić from Economic Chamber.
Yeah. Czech Chamber of Commerce. I'm so sorry. Thanks for an interesting presentation. I have two questions only. So, interest rates first. So, what do you think of the risk of difference between Czech interest rates and rates of ECB? Should it influence borrowing from abroad? How do you take this moment into account? So, the first one. And the second one, I would like to discuss consistency of your forecast. What is about GDP deflator, about 5%, when the inflation rate is 8.5? I have looked on equations in Chamber model, and it seems to me that the difference cannot be explained by exchange relations only. So I'm very interested for your explanation. Thank you so much.
Foreign currency denominated loans have been playing quite important part important role in some parts of the Czech economy, especially in the industrial sector. in exporting firms and in some real estate firms and some other segments of the economy. Those foreign currency denominated loans have been taken primarily in the past as a natural or balance sheet hedge against the exchange rate risk, and went dramatically up their share during the existence of the exchange rate commitment, when the firms started to fear about the possible future strong appreciation of the currency after we scrapped the floor. So in those segments there is relatively strong balance sheet situation of that firms as this doesn't pose any substantial risk to the financial stability and to the balance sheet liquidity of those firms. You're right that the interest rate differential against the Czech client interest rates and the foreign interest rates has been driving increasing demand for foreign currency denominated loans. Their share has gone up by approximately 3 percentage points compared to June when we started hiking interest rates. But this is still very low in international standards. It is solely dedicated to or concentrated in that particular segments. There is no substantial, or there is negligible share of foreign currency denominated loans in household sector. That's why we are not, we do not fear from some negative effects of that on monetary policy transmission and on the financial stability of the country. We have been monitoring the developments, but currently it doesn't make any strong conclusion for our monetary policy decision making and for the forecast as such. And for the consistency between GDP deflator growth and CPI inflation, I will ask Karel.
Yes, indeed, you are right that there is quite a big difference between the deflator and inflation. However, when we check the deflator for each of the components of GDP, then the difference is not as big. What I mean, indeed, the deflator for the household consumption is quite close to the inflation, which is indeed the link that is, I would say, tighter, because the inflation is measuring the prices of households of their consumption, so it's more related to these components. So these are roughly the same, and then indeed to have the overall GDP deflator that is somehow lower, then the other components are contributing to the lower number, and that's mainly the expenditure of the government. The deflator is lower, quite low there.
Maybe if I can add to the interest rate differentiator between Czech Republic and Eurozone, 2 comments on these loans. As Petr said before, we don't see significant growth of Euro loans, but it's natural. If you have income in euro, it's natural to borrow in euro, but the increase is not significant. It's roughly 3%, as Petr said. Second point is, I would say, more important. Very often we discuss the level of interest rates also for entrepreneurs. And I mean, this is not only one parameter of investment. Yeah? Because if I hear from entrepreneurs and from the market that, for example, prices could change twice a day, it's very difficult to consider any investments on one side, and also it's also very difficult for the banks to consider all these investments. Yeah? So we want to stabilize the situation Yeah, so it's not only about the interest rates only, it's about the overall macroeconomic situation. And the last comment also from our interest rate path, you can see that we want to expose our market to radiation of higher interest rates only for a short period of time. Yeah, so this is my last comments to the level of interest rates or comparison of interest rates between, for example, Czech Republic and Eurozone.
Thank you. Now, if you don't mind, I will read the two questions from Mr. Cervera from JP Morgan. The first is for Petr Král. The projection sees interest rates peaking in the first quarter of this year at the level 4.8%, but then falling significantly until the end of the year into the level 3.8%. How to interpret this quick reversal with the framework of the model, and why are higher rates needed for such a brief period in front of us?
The story of the forecast is such that the domestic monetary authority has done a great job in tightening monetary conditions via both interest and exchange rate component of it. Following the peak of inflation, which is ahead of us and no one can do anything with that, we will be concentrating on the inflation outlook in 2023. And after the monetary authority in the model sees that the previous tightening of monetary conditions has started to generate some disinflationary pressures, these pressures will continue for some time due to some persistence of economic mechanisms and due to the fact that inflation expectations became very firmly anchored close to the target. And following those mechanisms and assumptions, the outlook for inflation at the monetary policy horizon is very benign and very suitable or convenient for starting interest rate decrease or interest rate cuts. In the forecast, actually, some interest rate cuts could be seen as roughly from the second half of this year. Those are also, let's say, consistent with the fact that after widening the interest rate differential to such a big extent, and after having inflation on its path back to the target, we need to take care of the interest rate differential from the exchange rate perspective. And if we take the assumption that the ECB will stay in a very accommodative stance during this year and possibly maybe further, which might be a subject of the discussion, especially after yesterday's ECB meeting. But having this on board, we have to take care about the width of the interest rate differential, not to create too much appreciation pressure, and not to undermine our ability to fulfill the target and not to undershoot the target during next year. That's why we have to correct somewhat the width of the interest rate differential by slowly decreasing domestic interest rates. But it is assumed, or it is based on the assumption that inflation battle has been successfully won, and that the foreign monetary policy setting will stay accommodative, such as assumed in the baseline scenario. If anything from that differs from our assumptions, then we would end up with somewhat different interest rate path. But this might be more a topic for discussion of policymakers, and that's why I would like ask Tomáš whether he has something to add.
Yeah, this was the second question from the Mr. Cervera. It was for the personal opinion of Mr. Nedecký of monetary policy. I will read it. How do you see the model indication of rate cuts in the rest of the year, and how does it compare to your own assessment of what will be necessary?
Thank you for the question, first of all. If we compare our latest forecast with the last one, I mean, the story is still the same. We have already indicated that in the future there will be some cuts of our interest rates. This is also visible in our latest forecast. The difference Peter presented is that the magnitude or the mountain of inflation is a little bit higher. What we also see, the higher level of inflation, it will take a little bit longer time. That's the reason why we react yesterday as we react. But if our basic scenario of our forecast or the reality will follow our basic scenarios, we can expect that in the second half of the year we will discuss decrease of our interest rates or cuts. There is a lot of risks and uncertainties ahead of us. We have to pass a lot of milestones. The first one will be Valentine's Monday, inflation in the Czech Republic. So we will see what will be the final figure. But if you look at back these days, 1 year ago, we were almost on the target with inflation. So as I said, we have to pass a lot of milestones, and based on our forecast, we are convinced that we could start the discussion about prospective cuts in the second half of the year. And the reason is that in comparison with other central banks, we have started with our tightening, I would say, on time. Yeah, I have heard that we could start a little bit sooner, but I remember when our team of experts from monetary sections presented at the end of 2020, it was in autumn, monetary report that we should start tightening of our monetary policy. It was taken as something extraordinary, but at the end it proved to be right. Yeah, so, but as I said, a lot of milestones we have to pass are still ahead of us. Yeah, but I mean, the conditions we set yesterday and before create good preconditions to start the discussion in the second half of the year, if it works.
Thank you. Is there any other question? Yeah.
In the light of the new projections, what do you think appears the most probable outlook for macroprudential measures? I mean, do you think that has the model signaled that interest rate cuts are going to come at some point in the near future? Could that mean also macroprudential measures may begin to soften, given that the housing market will weaken, or actually maybe they stay or they worsen? Thank you.
I wouldn't say weaken or worsened. You know that what I see as a milestones, we were able to put our macroprudential measures into legislation, which was very important just to create a level playing field for all subjects on the market providing mortgage loans. As a part of our measures at the beginning of pandemic, we have withdrawn our macroprudential measures, focusing on overheated residential real estate market. The message was that at that time all banks were aware that the situation in the future will be difficult. So we were aware that they will focus on risk management and credibility of prospective clients very prudently. Yeah. The situation, and I mean, we were surprised as during the pandemic crisis, we were surprised in many areas. So we have, and following the new legislation, we have introduced these macroprudential measures. There is some time lagging how we can inform about the changes, and when all these changes are effective, all these macroprudential measures will be effective in the beginning of April. And also this is what we have learned in comparison with monetary policy. We want to set these measures, and we will keep these measures on the levels we set for a long time, because as I mentioned, we have learned that to create predictable and stable environment also for banks and also for clients, it has also its value. Yeah. So it must be predictable, because, as I said, the issue is always when we change all these macroprudential measures, it creates some, I would say, kind of marketing, which it has no significant impact on financial stability, but there is no reason to change these measures very frequently and create this unstable environment for banks and also for clients. Am I clear? Am I clear? Or, yeah? Okay, thank you.
Thank you. Is there any other question? If not, if everything clear, so I would like to thank you for coming.
May I maybe just one message before?
Of course.
I hope you can hear me, but just before you wrap up, just one last comment. Yesterday I was a little surprised that the market could be surprised that we didn't surprise the market. I just want to make it clear that our intention is not to surprise market. Trust me that the board meeting doesn't start like, hey guys, good morning, what about to surprise the market today? No, this is, I would say, side effect of our broad discussion after the presentation. As you could hear from Peter today, we have a broad discussion, then we decide, and we always discuss what will be the impact of our decision on the market. We know that in the past we have little bit surprised the market, but as I said, it was side effect, and we want to send a message that inflation is very important topic in our economy. So that was the only reason, and I want to use this opportunity to say that and on behalf of my colleague, I can speak that we appreciate your communications of our decisions. Definitely, you are very important part of our transmission mechanism. So this is what I wanted to say at the end of our today's meeting. Our intention is not to surprise the market. Thank you.
Thank Mr. Niedecky to the last words, and thank you for coming. I will looking forward to see you there again on 6th of May. And also I would like to thank my colleague for presentation and to be participant in discussion. Bye.